Welcome to Spidell's California Minute. I'm your host, Catherine Zidane. This week, we're covering Public Law 86272, which protects businesses from being assessed state income tax if their only activity in a state is the solicitation of orders. We'll be covering this topic, plus when a business and its owners are subject to California tax, nexus, what is included in California's sales factor, and more at Spidell's California Taxation of Multi-State Businesses webinar on July 29th. For details and to register, go to spidell.com and click Webinars. Business taxpayers who have a limited physical presence within a state may be able to use the Federal Interstate Income Act of 1959 to avoid paying state income taxes. The act is more commonly known in our industry as Public Law 86272 or just PL 86272. Under PL 86272, a business is protected from a subject state's income tax if the business's only activity in the subject state is the solicitation of sales orders of tangible personal property, and the orders are sent to, approved, and shipped from outside the state. If businesses stay within these narrow boundaries, then the subject state cannot force the business to file an income tax return or pay corporate income taxes to the subject state. We've all heard the saying, sales is all about relationships, but the key question for PL 86272 protection is, what are those relationships being used for? If the relationship is only being used to make sales, then the company is protected from state taxation. If the relationship is used for more than promoting sales, then it's not protected. Appeal of Ken's Foods, a recent pending precedential case before the California Office of Tax Appeals, provides a prime example of how the OTA approaches the PL 86272 analysis to determine if an out-of-state business taxpayer is subject to California income tax. Ken's Foods is a Massachusetts-based manufacturer of dressings, marinades, and sauces, for example, the Ken's Steakhouse brand. It has no California facilities or California inventory. However, it did have California employees. That alone doesn't mean that it automatically lost its PL 86272 protection. It could still be immune from California taxation as long as those employees were only involved in solicitation activities. The company had two California-facing sales operations, a retail side with managers visiting supermarkets working alongside a third-party broker, and a food service side with managers calling on chain restaurants supported by a corporate chef who cooked samples at customer presentations. The OTA found that the employees' activities that focused on how the company's products were properly displayed in supermarkets through stock checks, retail audits, demonstrating how products should be displayed, and display compliance visits were all protected solicitation activities because they were only done to promote sales. Also protected were the employees' customer check-ins and complaint forwarding services. These were all relationship-building activities that have long been held as protected activities in the courts. However, there were two activities undertaken by the California employees that crossed the line into unprotected activities. First were the activities involving collecting competitor product samples and customer information for product matching and product creation. The food service managers picked up competitor sauces from restaurant clients, sent them to the Massachusetts R&D team, and worked with the customers and R&D team until a matched or newly created product was accepted. The OTA found that there were other business reasons to conduct these operations, such as competitive intelligence, expanding the product library, and gathering market data on regional tastes, and these went beyond protected sales activities. Second, the corporate chef conducted pre-visit market research in California using industry databases, reviewed customers' existing menus, discussed flavor options with the restaurant cooks, and then built sample menu presentations for restaurant customers around those findings during sales presentations. Again, this type of customer research and the market intelligence gathering all could be used for non-solicitation activities. The key takeaway from this case is that if the employees' activities could be undertaken by non-sales employees, such as product development or competitor research, then PL 86272 protections do not apply. This is true even if that activity would promote increased sales. Speidel's California Tax Letter is a monthly newsletter that will ensure both you and your clients are up to date with California tax law changes. You can get subscription details and download a sample issue at speidel.com under Publications. That's all for this week. Join us next time for another episode of Speidel's California Minute.